Joining us at the Bloomberg Forum is Roger Debard, founder of the Fixed Income Department at Hotchkiss & Wiley in Los Angeles. Thanks for coming in.
Thank you very much.
Stock market has taken a hit recently. What does this mean for the bond market? Should we see more funds coming in?
Well, I think part of the reason the stock market has taken a hit is because interest rates have gone up rather substantially in the last 3 months. The low point for the long bond was about 6.35 at the bottom, and now it's well over 7%. So that percentage increase in fixed income yields has had a rather dramatic competitive effect on owning stocks.
You mentioned 7% yield on the bond. How much further do you think it will go before bonds become a buy?
Well, we've had a view for now some time that the economic cycle will likely play out, and how long is anybody's guess. We're rather long in the tooth now, and we're measuring it in almost 6 years, so it's a long tail cycle. I suspect for another few quarters, and the top of the yield level for long bonds would likely be maybe 7.35 to 7.5%. That's compared to approximately around 7.10 today.
And what time period do you see that level? Do you see us reaching that level?
Well, that's what's so difficult to put a time period on, but it's with the idea that the economy is not going to scream on forever, so that some number of quarters, maybe 3 quarters, maybe by the end of 1997, we could certainly see the top of interest rates, and at that point, if the economy begins to soften, then yields will come off. And they could likely come off to the 6.5–6% level.
If we're so far into the economic cycle, and to the extent that higher interest rates will affect corporate profits, what are you doing in your bond funds to prepare for a slowdown in the economy?
Well, last year, in 1996, it was a year that started with relatively low yields. Again, using the benchmark of the long bond, it started at about 6%, and by mid-year it had increased to about 7%, and we had significantly extended our maturity across the board. And we manage money from short-term investment funds, short-term bond funds, to total return bond funds, so we're dealing in the whole spectrum. We were above our benchmark duration maturity, if you will, by a rather substantial amount at the point that interest rates had gone up well over 7% in 1996. By the end of the year, we had brought that down to the benchmark, so we're, if you will, market neutral.
Can you explain a recent trade that would be an example of that?
Yeah, simply taking a long treasury, a 10-year to a 30-year treasury, for example, and trading that for a mortgage-backed security that would have a maturity of maybe 3 to 4 years. And that process of taking long maturity bonds and trading them for shorter maturity bonds reduces the risk in the portfolio. We were trading a treasury issue which has high quality for another high quality investment, a AAA investment, but because it's a mortgage security, more complex, having a yield spread against treasuries, we were able to effectively maintain and in fact enhance the yield.
But what about for lower quality bonds? What are you doing there to prepare for higher interest rates?
Well, the lower quality bond is one that would be used very selectively, and particularly at this stage of the economic cycle, you wouldn't want to, I don't believe, own a majority of a portfolio, particularly an investment grade oriented portfolio, in lower rated bonds, only because at the point that the economy does soften, the history has shown, and there's no reason to believe that won't be true for the future, will be an expansion of the yield levels on lower rated bonds compared to high quality treasuries, and effectively the price will go down more on the lower rated bonds when the yield levels go up. Have
you been selling the high yield bonds?
No, we've really been maintaining them. They still continue to offer a substantial premium, but we have not been adding to those positions.
Okay.
We have in round numbers maybe 10% of a portfolio in lower than BBB investment grade rated bonds.
Are there any particular bonds that are sort of the that you own more of in the portfolio that you're particularly?
Well, for example, in the lower rated area, we own an Oryx energy bond, and that's a company and in an industry that has had an improving credit profile. So that's the kind of lower grade bond that we would choose. As an organization, we're really more dedicated to maintaining high quality portfolios, investment grade oriented portfolios. So we will use lower grade issues to enhance return, be opportunistic, be intelligent about building a diversified portfolio.
And those are the bonds that are, even though they're junk bonds today, they may turn out to be investment grades of tomorrow.
Absolutely. In fact, whenever we would buy a so-called junk bond, a high yield bond, it would be with the idea that it would be an improving credit.
Let's turn to the asset-backed market. Investors are hearing a lot about how utilities are going to solve their problem of so-called stranded costs for investments they made 10 years ago by paying for that through the sale of bonds backed by a charge on electric bills.
Right.
Are you planning to look at these bonds, and how do you think they'll compare to the asset-backed market that's more traditional, like credit cards and auto loans?
Well, we are looking at that market, and we anticipate it's going to be an extremely large market. There will be many issues, and the size of the issues will be substantial because you just have to look at the large number of utilities. There are well over 50, 60 major utilities, 30 of which will likely participate in some way in a combination or individually in many cases. The decision, though, whether we buy them or not, will be based on how attractive the spreads will be, and we estimate the spreads will be approximately 45 to 50 basis points. In other words, about 0.5% over an equivalent treasury. And at that point, we're somewhat indifferent. If it came at a higher spread, we would be more interested.
Typically, the first to come to the bond market with a new type of security, company might have to pay a little extra yield. In this case, would you expect the first issuer, whether it be a California or a Pennsylvania utility, because those are the states that have approved the sale of these bonds, would you expect there be a large premium to pay, or?
No, I expect that this one will be so well researched, so well anticipated and understood. It's not so complex. The industry is pretty well known and understood. Analysis has to go into the credit and the stranded investment amount will come to play in an individual bond decision in terms of the dollar amount. Certainly the political environment in California, in Pennsylvania, or any other state will be an issue, but there will be no mystery in terms of what the value will be. If it's a relatively high premium being offered for these bonds, I think the market will have a great appetite for them.
Let's turn to the Federal Reserve. A couple of weeks ago, the central bank raised its target for Fed funds for the first time in a couple of years.
Yes.
Typically, the Fed moves have been followed by a series of interest rate increases. What's your outlook for the Fed's actions this year?
I believe that was a preemptory raising of the flag, and the 25 basis points, I suspect, is going to be all that will be done at the current level. I believe that the difference between 1997 and maybe 1994, which was really the last time that the Federal Reserve had that succession of interest rate moves up, was a very different environment. Number one, they were starting from a very low base. Interest rates in 1994 were at 3%. Today we're at 5.25%. So the hurdle rate was higher. There's not that need to raise interest rates substantially from that high base level today. I think the Federal Reserve will not likely raise rates substantially, and when I say substantially, more than maybe 25 basis points until they actually see evidence of the problem of inflation. That's what they're trying to anticipate right now. If anything, maybe there was an effort to cool some of the ardor in the stock market by raising interest rates. That is something that's been implied but not explicitly said by Chairman Greenspan.
Well, that's about all the time we have. Thank you for joining us.
Thank you.
We've been speaking with Roger Debard, founder of the Fixed Income Department at Hotchkiss & Wiley. For the Bloomberg Forum, I'm Marianne Busso.